Alberta wants a pipeline to Tidewater so it can access customers in Asia and Europe. New Canadian Prime Minister Mark Carney wants to give it to them. Know what question no one is asking? Do customers in Asia or Europe want Alberta's ultra-heavy sour crude oil? Short answer is no. Let me explain why. But first, here's a clip of Carney explaining his position on new oil pipelines.
Are you going to build that pipeline if the consensus exists?
First off, I've said repeatedly yes, first point. Secondly, that because I understand the need for that consensus, I'm a prime minister who can help create that consensus. You can't create a consensus on your own, but you have to drive processes that bring provinces along, bring the private sector in.
The only supply of Canadian crude oil that can grow is the 170 billion barrels from northern Alberta's oil sands. Alberta conventional oil production in the Western Canadian Sedimentary Basin is old and is topped out between 500,000 and 600,000 barrels per day. Saskatchewan and Newfoundland and Labrador can't significantly expand production either. Now, heavy crude requires special equipment to refine it. There's only 10 million barrels per day of global refining capacity that can handle heavy crude, and 5.5 million barrels per day of that capacity is in the United States. Since some Western Canadian Select, Canada's heavy crude benchmark, is refined or upgraded at home, the United States and Canada combine for 68% of global heavy crude demand. So, right out of the gate, Canada is now chasing customers in the remaining third of the global market. While it is clearly the low-cost supplier in the US, it is a higher-cost marginal supplier in other markets, mostly because of higher transportation costs. Let's consider the cases of China and India, which together account for 26% of global heavy crude oil demand. China's refinery and petrochemical complexes currently import about 1.5 million barrels of heavy crude, which is expected to rise to 2.5 million barrels by 2030. One factor inhibiting WCS imports is that Saudi Aramco, the biggest heavy crude supplier to China, is a joint venture partner in 3 or 4 of those complexes. The Rongsheng complex is already committed to 300,000 barrels of WCS, and as expansion grows demand, WCS is expected to be one of the heavy crudes that will supply more product. U.S. sanctions against Venezuela also create more opportunity for WCS. TMX tolls and shipping are low enough that WCS is often a bit lower than competing grades. So, okay, that's the upside. The downside is that WCS carries higher concentration of metals, acid, and asphaltenes. Many of China's independent teapot refineries, which already run over 1 million barrels per day of heavy crude, don't have the equipment to process WCS. If it is used, then the refineries discount it more heavily than the Middle Eastern grades. China's government has also introduced quotas and taxes that penalize using heavy crude in some refineries. China is also busy electrifying its transportation sector. Sales of light-duty EVs were over 50% last year and could be over 60% in 2025, while sales of medium-duty EVs like delivery vans are taking off. The heavy-duty truck fleet, such as highway freight haulers, is being converted to liquefied petroleum gas, reducing the demand for diesel. The bottom line is that there is some growing demand WCS can supply in China's petrochemical sector, but there are plenty of competitors with long-established customer relationships. The electrification of transportation is a major risk factor. Now let's talk about India, which imports just under 5 million barrels per day, of which 1.1 million to 1.4 million barrels per day is considered heavy crude. It has a number of refineries and several with integrated petrochemical complexes, and many of them consume at least some heavy, which they rely on because of the steep price discounts. Cost is critical in this market. Pipeline and dock tolls in Vancouver combined with marine shipping, can cost around $15 US per barrel. That prices WCS out of the India market unless the differential between WCS and West Texas Intermediate is high, in which case Canadian suppliers will further discount exports to India. The Trans Mountain Expansion Pipeline has enabled imports of 20,000 to 50,000 barrels per day of WCS, and India could import a bit more than this, but its refineries are configured mostly for Basra, heavy from Iraq. At best, Canada is a marginal supplier to India, and there is little reason to believe this will change in the future. So, bottom line, if TMX, Trans Mountain Expansion, pipeline was expanded from 590,000 barrels per day to 890,000 barrels per day, which the pipeline operator says is feasible, it will take a long time for growth in heavy crude demand in China and India to fill TMX pipes. There are many risk factors, not the least of which is climate policy and the energy transition, that suggest the demand for Canadian oil does not justify even one new pipeline, never mind several. So why isn't future market demand for Canadian heavy crude oil part of the national conversation about new pipelines? Why is that conversation always focused on how much more oil Canada can supply rather than whether or not there's enough demand from customers? Our Prime Minister has a PhD in economics from Oxford and is a globally respected banker. If he doesn't ask the hard questions about the business case for a new pipeline, who will? Frankly, I think we all know the answer to that question. Nobody.